Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing CVRx's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. CVRx is a medical device company focused on developing neuromodulation solutions. Neuromodulation solutions are for patients with cardiovascular diseases. Neuromodulation is the alteration of nerve activity through targeted stimulus, such as electrical stimulation or chemical agents. Its purpose is to normalize nervous tissue function. The company's main product is Barostim, which is a neuromodulation system for the treatment of heart failure and high blood pressure. It is an implantable device that electrically activates baroreceptors. Baroreceptors are the body's natural blood pressure sensors that regulate cardiovascular function. Barostim is the first medical technology approved by the FDA that uses neuromodulation to improve the symptoms of patients with heart failure. The company is headquartered in Minneapolis, Minnesota. It was founded in 2000. The ticker trades on the NASDAQ. Let's get started with the model. This is a micro-cap company, 121 million market cap. They're trading at $6 a share, and they have 20 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their revenue is still small, so they have negative free cash flow every year. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative each year. Revenue is a sales for the company, and that's grown from 6 million up to 14 million. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. That was highest in the trailing 12 months at 10.5 million. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income, which is negative every year. They spent 1.6 million of interest on their debt, which is lower than 2019, 2020, or 2021. Below that is other income and expenses. These are all the gains or losses not part of the company's core operations. Then you have your pre-tax income. They don't pay much in taxes since they're not making any money. And the bottom line of the income statement is their net income, which is negative every year. This is the company's most recent income statement, the first quarter of 2022 compared to the first quarter of 2021. Their revenue in the first quarter was 4.1 million. 3 million of their revenue is in the US, 1 million in Europe. It looks like they sold 99 units of Barostim in the first quarter compared to 44 products in the first quarter of last year. The company mentions the increase was driven by continued growth in the US by their heart failure business as a result of the expansion into new territories. Also, more awareness of Barostim. As of the first quarter, the company has 56 active implanting centers compared to 19 last year. It looks like their sales team is focusing on 17 territories compared to just 6 last year. They implanted 50 units in Europe in the first quarter. That's down from 52 units in the first quarter of last year. The decrease is due to COVID-related headwinds. It seems like the easy out. If anything goes wrong, just blame it on COVID. And in Europe, they're focusing on 6 territories. Their gross profit is 3.1 million, up from 2 million. R&D is 2.3 million, SG&A 11 million, so they have an operating loss of 10 million. Their loss per share is 49 cents compared to $24 last year. The reason their loss per share is so much better in the first quarter of 2022 compared to the first quarter of 2021 is because they have so many shares outstanding. They can spread those losses across a lot of shares. But when they're profitable, it's going to be the same thing. Their earnings per share are going to be a lot lower with a lot more shares outstanding. In the first quarter of 2021, they had 361,000 shares outstanding. Now they have about 20 million. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses from its operational business. and they spent $1.2 million in CapEx in 2021. These are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. Since they have negative free cash flow, they're running their business on capital stock. They issued $133 million in 2021, $50 million in 2020, and $25 million in 2019. Every time a company issues common stock, it increases the shares outstanding. It makes your shares less valuable. This is the equity section on their 331 balance sheet. They have $137 million in equity. They raised $541 million from selling their business, and they lost $405 million from running their business. Let's look at the capital structure. $137 million of equity and no debt. You can see their equity balance and their cash balance have been going up at a similar rate, because when they issue preferred or common stock, they receive the cash, so their cash balance and their equity balance goes up. And it looks like they paid down all their debt in the first quarter of 2022. I gave them the highest whack on Finbox, 9.3%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's $157 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $104 million. We divide that by 20 million shares. And we get a calculated stock price of $5. They're trading at $6, so they're trading at a 17% premium. It's a sell according to the model. Their revenue in 2024 is projected to be $67 million. In 2023, it's supposed to be $41 million. And in this year, they project about $21 million. In 2025, I calculated $93 million of revenue. I just grew it at a similar rate as prior years. That's how I got their future revenue estimates. The average company in their industry converts 11% of their revenue into free cash flow. So I multiplied their 2024 and 2025 revenue by 11%. That's how I got their future free cash flows. And I assumed they would have negative free cash flow in 22 and 23. 3 analysts priced this stock and the average price target is $11. It looks like the stock IPO'd at over $20 and it's only gone down since then. The stock was below $5 at its lowest point, so $5 may be the resistance point, so it could be a lot of upside from here. The stock is down 78% in the past 52 weeks, while the S&P is down 1.5%. The 52-week low is 460, the high is 29, and the stock is trading below its 50-day and 200-day moving average. 300,000 shares have been traded each day the past 10 trading days. Of the 20 million shares outstanding, 11 million are on float, 80% are held by institutions, and over 6% of the shares are shorted. They currently employ 109 people. It looks like it grew a bit from last year. In the past 12 months, there's been only insider buying, no selling. Here's a list of all the insider buying: the date, the person or the company, the number of shares, and the price. So I'm sure these people who paid over $20 aren't happy, since they could have got the stock for a lot lower today. The salary for the CEO is $481,000 and their total compensation package is $1.7 million. If you put $10,000 into this company when they started trading, you'd be at $2,400 today. That's a 76% loss. 45% of the company is held by venture capital and private equity firms, 43% by institutions, 9% by the general public, 1.3% by public companies, and 0.9% by insiders. The massive company Johnson & Johnson is the biggest shareholder at 17%, New Enterprise at 12%, Guild Healthcare at 9%, Vensana, then Solus. Let's look at their financial ratios. We can't look at the PE since they have negative net income. Price to sales is 8.5, that's stock price over sales per share. Price to book is 0.9, that's stock price over book value per share. So if the company liquidated today, they would be able to give each shareholder $6.68, which is more than they're trading at. And we can't look at the price to free cash flow since they have negative free cash flow. Let's look at their non-current assets. $1.7 million of property and equipment and $26,000 of other. Let's look at their non-current liabilities. They owe $300,000 on operating leases and $700,000 of other. They have a really high current ratio of 22. That's current assets over current liabilities, and a quick ratio of 21. Let's look at their current assets. $132 million of cash, $4 million of accounts receivables. This is how much money their customers owe them. $5.3 million of inventory. These are their implantable devices. $2.1 million of prepaid expenses. This is when a company makes an advance payment for a product or service they're going to receive in the future. Let's look at their current liabilities. They owe $1.6 million to their vendors and $5 million of accrued expenses. These are expenses the company has incurred, but it has not paid it yet. Their free cash flow in 2021 was negative $29 million, but they have a lot of working capital, $136 million. So it looks like the company has enough money to get through the next 12 months without doing another capital raise. The best way to look at ratios is to compare them to companies in the same industry. There are 153 companies in the same industry as CVRx, and if CVRx has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So it's really hard to look at their ratios at this point because they're so small, but they do have a much better price to book and price to sales than average. They don't have any debt anymore, so that's good, but everything else they're worse than average. They're a really small company, 121 million market cap. The average is 5.6 billion. So to summarize, I have them trading at a 17% premium, but it's almost impossible to value this company because their numbers are not consistent. Their revenue is really low. Their free cash flow is still negative. The stock is a great value if you have confidence in their products because it's trading at a huge discount relative to its IPO price. But of course, manufacturing a product, marketing it, getting others to use it, scaling it is a really difficult thing to do. So I'm really excited to see how this company does over the next few quarters. I rank their free cash flows 1 out of 10, their revenue 3 out of 10, and their ratios 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.